Good morning and welcome today to our webinar on the Italian yield curve and BTP derivatives during highly volatile markets. My name is Francesca Dell'Era and I'm fixed income derivatives sales at Eurex, and I will be moderating our webinar today. So this year was and still is a volatile period in the markets. In this context of uncertainty, lockdowns and intervention from central banks, the exchanges committed to remain open to allow for continuous and reliable price discovery. So today, together with our market experts, we will discuss the impact on the Italian and European yield curve, what role BTP derivatives have played for investors, and how their liquidity helped navigating through such volatile times, and also what's coming next. So now let me introduce you to our agenda and speakers. Today, we have here with us Luca Cazzulani, co-head of strategy research at Unicredit Milano, Catherine Alexander, fixed income derivatives sales at Eurex, and our panelists, Andrea Stramentinoli, head of interest rate derivatives at Banca Akros, Ashley Ball, senior fixed income trader at Mako Global, Michelangelo Gigante, head of execution desk at Horizon Capital SGR, and Jutta Frey-Hartenberger, fixed income ETD product design at Eurex. So before we start, I will just give you some short housekeeping details. In this webcast today, we are abiding by Chatham House rules. So please do not quote the speakers or reference this webcast without the written permission from both the speaker and the organizer, Eurex. For mobile phone app users, please note that you can change from slide to video view by swiping left or right. And throughout this webcast, we welcome questions from the audience. So please post your questions via the chat functionality on your control panel at any time, and we will address them at the end of each session. The webcast today is being recorded, and the recording will be made available to you soon after this live presentation. We'll also have some poll questions for the audience today, and then we'll comment the results during the panel discussion. So I would like now to have a first test. So you will now all see a question appearing on your screen. So please on your answer, of course, football related. Who wins the next European Football Championship? We will see the results soon. Oh, so the majority has voted for Germany and Italy. So we have two at first place. Thank you very much for contributing. So now we'll start with this presentation, and I will leave the stage to Luca Cazzulani, co-head of strategy research at Unicredit Milano, who will present his paper, Rates Market, How Have They Fared Through the Pandemic? We will also have a 5 minutes Q&A at the end of this presentation, so please post your questions via the chat functionality. Thank you, Luca.
Thank you, Francesca. Good morning, everyone. In the next 15 minutes, I will go through a presentation describing how rate markets have fared through this exceptionally challenging year. This is a year in which, as you see on these slides, we have faced, global markets have faced a recession with basically like no others in recent history. On this chart, you see the quarterly GDP growth rate in OECD countries since early 60s. And it's clearly visible the fact that this year we've endured an exceptionally strong contraction of economic activity. Just as a reference on the slide, you can see the deep recession we had during the Lehman crisis, which is before this event was thought to be the most severe one happening in modern times, and it just pales compared to what we faced this year. The important thing, though, is that this recession did not come from a particular imbalance in balance sheets. It was completely driven by the decision of policymakers, and basically it was induced by the decision to close the economy. In this chart, this is quite a popular chart. It shows the relation between the mobility, the possibility that economic agents have to do their normal activities, and the severity of recession across many countries. The message is quite clear: the stronger the decisions to restrict the economy, the deeper the economic contraction. And this is quite important because the fact that the economic contraction was entirely related to political decision, to the decision of lockdown economies, meant always it was possible to take strong action on the monetary and even more importantly fiscal side. And that's something we expect to continue to be a feature for the coming quarters. Now, in this chart, you see the development of euro area GDP along with the path, which is the gray dotted line, which would have been followed in case we had no COVID crisis. Basically, it's an extrapolation of the trend that was present from early 2015 up to late 2019. Then we had a big contraction, and the dotted red line shows our forecast for GDP dynamics in the euro area in the coming 2 years. We have just published our 2021-22 outlook with updated economic and markets projection, and basically we are embracing a relatively constructive view in which we actually see another mild contraction happening at the turn of this year, but then in 2021, as the weather improves and probably even more importantly as a vaccine becomes more widely available, we expect GDP to pick up, and as you see, we should go back to late 2019 levels of economic activity by the end of 2022. So that's a moderately constructive view. Of course, there will be still a gap between where we expect to be in late 2022 and where we would have been had there been no crisis. And that's going to be an issue for the policymakers to decide how to solve. But so far, during these quarters, the reaction by policymakers has been impressive and very bold, I would say. In this chart, you see that the ECB has stepped up massively its purchase activity in the euro area markets. This slide is specifically on public sector bonds. What is the key issue here? In a year of a very severe recession, there was a strong need for fiscal policy to become active. Unlike in past years and unlike in past crisis episodes, fiscal policy has played a very important role this time. And fiscal policy, expansionary fiscal policy, has been possible just because of the prompt intervention on the monetary policy side with a step up in purchase activity. Virtually all the net supply implemented by euro area sovereigns has been absorbed by the ECB. The ECB has also provided massive liquidity to markets. You see on this chart, the red line shows you the amount of cheap funding provided by the ECB, the LTRO funding basically, and this jump here is the June operation, which injected over $1 trillion of funds in the euro area economy, thus providing a situation of abundant liquidity. And the combination of expansionary fiscal policy and abundant liquidity and cheap funding provided by the ECB has basically calmed the markets. In this slide, I have plotted the yield curve of Eurozone, which is an indicator closely watched by the ECB. Is basically the level of different yield curves mixed according to the weight each country has in the Eurozone. The red line is where we were trading before COVID, and the crisis hit with a massive contraction in financial conditions, mainly in the weaker countries of the euro area. And then we had two progressive downward shifts in the cost of funding. The first one was related to the ECB launching the pandemic emergency purchase program, which is what I was saying before, making it possible for fiscal policy to be fully supported by monetary policy. So we had this first downward shift. And then we had the second downward shift, mainly related to the political response provided by the EU to the crisis, with the approval of the recovery fund. Both expansionary fiscal policy and the commitment by the EU to provide a sustainable and strong political response are factors that we expect to continue to prevail also in the next few years. And particularly in 2021, we expect that the ECB will remain active in the sovereign bond market, absorbing net supply and permitting to fiscal policy to remain accommodative enough to actually support economic activity. On top of this, of course, both the ECB and the Fed have been quite assertive in the need to preserve accommodative financial conditions. And in this chart, you see that markets are now expecting, both in the euro area and in the US, that monetary policy rates will remain subdued for a very protracted period of time. Actually, the situation in the Eurozone is a lot more subdued in terms of markets expecting stable rates than in the US, probably also reflecting different developments in the political levels. But the factors to me are pretty clear. We have a strong commitment on the part of monetary policy authorities to preserve low rates, abundant liquidity, and to keep intervening in the bond market in such a way that fiscal policy will be able to remain active as needed in the current condition, which is also an important break compared to the past, when we had, on the contrary, immediate warnings that fiscal policy should not be too much loose, so to say. In this slide, I highlight another important point, which is that in any case, we now have real yields deeply negative in the euro area. We're trading at about minus 1.4%. But the important point I want to make with these slides is that negative real yields are not something which arrived with COVID. Actually, the entire scale in this chart is negative, and it starts in 2015. The euro area economy has now been running on negative real yields for over 5 years, and it's something we should continue to expect to prevail in the coming years. So there's going to be a situation in which, to help economy to grow, real yields are bound to remain negative. Even back in 2017, when there was a synchronized period of strong growth, real yields in the euro area were negative. So that's something which is going to remain with us for quite some time and will shape investment decisions for some time. Coming to BTPs, BTPs have been quite resilient during the COVID crisis, but this has been mostly related to the factors I was mentioning before, the strong intervention by the ECB and the response, the political response provided by the EU. First of all, in this chart, you see that as soon as the crisis, the pandemic hit, the ECB started to increase its relevance in the BTP market. At the moment, we estimated that about 22–23% of the market of the BTP market is held by the euro system, and we expect that more will be purchased in 2021, bringing the total share to something close to 30%. It's an important factor that, in our view, is going to keep BTP yields subdued. The second point is who were the buyers and the sellers during the crisis, and this chart helps you to visualize the fact that there was an exit from foreign investors, which are the blue bars here. When the blue bar is in the upper part of the chart, it basically indicates selling by foreign investors. There was a massive selling in March and in April, and then you see all these bars here, which represented the buying flows during the crisis, and the buyers during the crisis was the ECB and were domestic players, mainly banks. So this has changed the composition of investors in the BTP market, away from foreign investors and towards more domestic investors. Now that the risk sentiment is improving, there may be pressure on foreign investors to come back in the market, take into account that the BTP market is one of the very few areas in the Eurozone where you still get positive yields. And this composition of demand is something that could push spreads a little bit more tighter in the coming few quarters and provides additional support to the market. Why would foreign investors come back to the market? This is one important piece of the puzzle. In terms of, we know that Italy has a large public debt, but over the last few years, this debt has seen declining cost thanks to market conditions. And the cost has been declining also during this year, despite all the tensions we had in March and to some extent in April on the curve. In this chart, you see the gray, light gray line is the cost of funding with BOTs, which is now in negative territory. The gray line here is the cost of funding at auctions for BTPs, which has also remained very well behaved and significantly below the peaks we saw during 2018, which was a trouble period specifically for Italy. Important thing is the red line is the overall cost of Italian debt, which has been declining. And once you take into account that the portion of the debt is held by the ECB, which basically gives back the coupons to the Treasury, the cost is now slightly less than 2%. So it's manageable. Italy has a debt has a large debt, but at the same time, this debt has a manageable cost. You see this resilience also at the short end. Back in 2018, when there was an idiosyncratic shock on Italy, there was a large widening in short-term yields, which lasted for quite a protracted period of time. We had nothing like this during this year. We, of course, had a period of very strong pressure, actually with a peak higher compared to 2018. But the important point is the pressure was short-lived. Because of the joint policy response, we now have BOT yields back at this level. This is the spread versus Germany. It has almost completely closed. It's a sign of very strong resilience. And by the way, balance of payment data show that foreign investors have already started to accumulate short maturity Italian bonds. The volatility was also well behaved. In this chart, you see that there was a volatility bout. This is the chart of the implied volatility. It was, of course, a period of uncertainty, but even here, it was short-lived. The spike was very short-lived. It was initially larger than we had in 2018, but it was short-lived. And now we are back at a level for implied volatility, which reflects investors' confidence about this relatively strong position for Italian BTPs. On the right, you see the so-called risk reversal, so the difference in cost for getting insurance versus falling prices relative to getting insurance versus increasing prices. And even in this case, you see that there has been a short-lived bout. By the way, it was Italy, more specific to Italy compared to Germany, which went through the crisis in a more stable way. But in any case, even on the volatility side, we now are back to more normal level. The other side of the coin is we had a very strong increase in trading volumes, possibly also because the Italian market is very liquid and is one that ensures the presence of derivatives, which can make it easier for market makers to trade the market. But as you see in this chart, particularly for BOTs and BTPs, which are the asset classes which attract more diversified type of investors, there was a massive increase in trading activity. This reflects the fact that investors have been more keen, for example, in searching for relative value opportunities in the curve, but also the fact that at some point, Italian BTPs were the only place offering a yield, an interesting yield in the euro. I think this high level of trading activity is something which could remain with us also in 2021, both related to the ongoing presence of the ECB and the fact that we are now in a situation of low yields where all investors will be under pressure for yields. As a final thing, this is helpful to make a final consideration of our expectation for the spread of BTPs. We expect that in 2021, low yields and abundant liquidity will keep all investors under pressure for yields. From here, we see some moderate room for tightening in BTPs, taking into account, however, that historically tighter level in BTPs, like 100 mark, were observed only in very, very favorable situations, particularly in conditions that were very favorable for growth, which are not necessarily what we're expecting for 2021. And with this, I have covered the key points of my presentation, and I hand it back to Francesca.
So thank you very much, Luca. Always very interesting to hear from your research. We'll have maybe time now for a couple of questions from the audience. So I'll read you the first one. From your analysis, we could picture a gradual recovery that could lead maybe to a path of increasing rates. What are the main risk elements in your forecast?
Thank you for the question. Well, our forecast is mainly based on the fact that we now have a vaccine available, and in any case, in 2021, at some point, improving weather will permit to reduce the restrictive measures on the economy. Clearly, the presence of a vaccine, its effectiveness in the possibility of distributing it smoothly is one of the key points for the constructive view. So that's one important source of risk, of potential risk in the forecast. The other one relates more broadly to the dynamics of risk appetite and the way it will evolve. There are, of course, also positive risks. There is the possibility which we should take into account that the distribution of the vaccine or medical treatments more in general happens faster than we are now expecting. We are expecting it to occur in the second half of next year, starting from the second half of next year. But there is also the possibility that this will happen faster.
Thank you. So we also have a second interesting one. So central bank intervention has been very important during this difficult year. And now we are heading towards the last ECB meeting for this year. What are your expectations?
The December meeting promises by the ECB promises to be an interesting one, and as I said, central banks were quite important and active during this year. We expect that at the December meeting, the ECB will make it clear that conditions will remain accommodative also through next year, so probably announcing an expansion of the PEPP envelope. So to make sure that there will be enough ammunition on the table to keep markets going at the current levels. We also expect that they will announce an extension of the favorable TLTRO III conditions in such a way to ensure that liquidity and cheap funding for banks will remain available at least through 2021. And we do not expect actions on rates, on the depot rates. It's already low enough.
Thank you once again, Luca. And now we'll hear from thank you very much. And now we'll hear from my colleague, Catherine Alexander, fixed income derivatives sales at Eurex, some insights on the trading activity of both BTP futures and options, and also we'll look at our product roadmap. So welcome, Catherine, and I leave it to you.
Thank you very much, Francesca, and good morning, everybody. My name is Catherine Alexander, as Francesca said, and I work in the fixed income sales team at Eurex, based in London. Over the next few minutes, I will share a short update on general fixed income volume developments throughout 2020 so far, highlighting, of course, trends in the Italian segment for the purpose of today's session. It goes without saying that 2020 has been a year like no other, with the COVID-19 pandemic the dominating factor and severely impacting the EU economy. We have witnessed various fiscal and monetary actions by the ECB and respective European governments in attempts to stabilise and boost their economies, as well as reinforcement of QE. Overall, 2020 has been a mixed one for fixed income at Eurex. The first quarter saw a relatively strong performance before a severe correction in quarter two, unsurprisingly. The third quarter has been a more upbeat trading environment in comparison, with the OAT and Schatz futures seeing the largest quarter-on-quarter increase, up 11.8 and 9.6 respectively, albeit somewhat lower than last year. Perfect. Now, the markets have been characterized by some broader themes. Underlying rates markets remained in tight ranges and volatility at historical lows. Combined together, this makes for quite a challenging environment, particularly to recover from the COVID downturn experienced earlier this year. Saying this, there have been some standout products to note. We can see on this slide that the table isn't all red. We do have some green glimmers here across some of our contracts. OAT futures had both a strong third quarter and 2020 overall, and volumes have been up 9% on the previous year. Vauxhall futures also built momentum up this year, up 5%. The flattening of the yield curve has favoured trading activity at the long end, and our volumes in the futures was also boosted from the launch of our Vauxhall options earlier in September, exactly September 28th, which actually has already seen over 52,000 contracts traded to date. The Italian segment has gone from strength to strength. ADVs up 4% and 2% in the BTP and BTS futures. And this, of course, has been triggered by COVID impact in Italy and surrounding geopolitical issues. So now let's focus on the Italian segment. As I just highlighted with some statistics, the Italian futures market has remained stable and has actually even seen some growth during this year, which has been one, as I mentioned, has been very challenging for fixed income markets. ADV for BTP futures now stands at 117,000 contracts and 97,000 for the BTS futures. They continue to be the most successful growing futures in the segment alongside our OAT futures. The Italian segment has developed itself over the years to be a robust liquid trading and hedging tool for Europe. And we are starting to see open interest finally recover to post-COVID levels. Client support has remained solid over the years and the distribution is balanced well. We can see that the volume is not simply market maker driven, but is a healthy mix across our client base, that being market maker, algo, prop, broker flow, and equally bank agency client business. There's a healthy mix across let's say the diversification of client base here, and this gives us both confidence in both the demand and stability of these contracts now and going forward into the future years. The top 20 Eurex members accounted for over 65% and 76% of the volume in BTP and BTS futures respectively. And interestingly, actually 97% in our BTP options, so a very healthy picture. Just a couple of changes to note on the Italian futures contract specs, which were just on the previous slide. In July, contract specifications were changed to include the newly created BTP Futura bonds, to exclude, from being deliverable into the Italian FI futures, simply because it's a retail-focused product. And in October, the BTS contract specs were revised to harmonise obligations for delivery. We did have plans to launch Ultra BTP futures this year. It's still on the roadmap with market consultation, but this was being somewhat delayed due to other developments in the European bond market, notably the next generation EU bond discussion, and no doubt my colleague Jutta will touch upon this in the panel session. Now, not forgetting options. We launched options in 2017 on BTP, and they've gone from strength to strength, being seen as a complementary product to the Italian futures and fixed income suite. Geopolitical risks and volatility in the underlying cash market created an environment that would see increased trading in BTP options. Incredibly, in the first half of 2020, we saw an increase of 11% on the same period in 2019, volume levels at 5604 in the ADV, and actually to put this in context, this was 10 times that of the OAT options. Italy suffered terribly from COVID early on, and concerns remained on the impact of lockdowns and various support initiatives, fueling volatility in this segment. Italian 10-year yield was trending downwards towards a historically low level of 100 bips. The Bund BTP spread then increased to 279 basis points in mid-March and retracted to 150 basis points in the second quarter of this year, as the pandemic ceased to dominate the news flow for Italy. Interestingly, end client flow in BTP options is around 50% of traded volume, and this is a reflection on how this product has gathered pace and momentum as a trading instrument and one to be considered in portfolios. It's evident that the Italian segment on Eurex, albeit younger in its listing, is growing in maturity and marking its place as a reliable liquid set of instruments to manage risk and gain exposure to the European market. This year has been a challenging one, to say the very least, but the Italian products have not failed to deliver. Now, this slide here really summarises the market trends that I referred to earlier, and also what Dr. Luca mentioned in his presentation, really focusing on how we are looking to expand our product suite to meet such market requirements and needs going forward. As I touched upon, we successfully launched Buxel options at the end of September with strong liquidity provider and broker support, strengthening our coverage at the long end of the curve. We launched with 7 market makers and have seen some decent end client tickets come through already. To date, we've seen just over 52,000 contracts, and ADV is close to 2,000, which for a contract which is only 2 months old and in this challenging environment is quite impressive. We've also seen an uptick in interest from a wider client base, and these volumes continue to grow in the right direction. The current rates and low volatility environment favours long-dated debt securities due to the high yield. So really, with the Buxel options launch, timing was key here. We filled a gap in the market where there was a need to get this extra exposure. And now with the Buxel options, we have full coverage on the German curve, which again provides further optionality for clients. Looking ahead to 2021, 2 product areas we plan to focus on in fixed income are ESG and next generation EU bonds. Both very topical and both have potential to be pivotal in the wider market going forward. We're already seeing a decent amount of excitement building for both these areas. In July, the EU Commission approved a 750 billion programme under the European Next Generation Recovery Fund as an instrument to address the COVID-19 crisis. The issuance of the new generation EU bonds will create a new liquidity pool with AAA rating And last month, in fact, the Commission issued their first SURE bonds, a total of 17 billion debt issuance. The Commission also endeavours to become the biggest green bond issuer. So in line, this is also bringing ESG into focus. Sustainable investing has moved from purely a buzzword to actually taking centre stage this year more than ever, and is actually now moving to become a focus in fixed income markets as well as equity. Eurex will be well placed to provide derivatives in both areas in due course, generating new trading opportunities across the EU yield curve and credit markets. So 2 product teasers to take away: features in the next generation EU bonds and fixed income ESG. So watch this space for 2021. Today's presentation will be sent following today's webinar. Again, all details of our contracts are found on the Eurex website, and our contact details for myself, Francesca and Jutta will also be on the presentation. So if you do have any questions, be it on existing volumes products or new contracts that I mentioned that we're looking to focus on in 2021, please do not hesitate to get in touch at any time. Thank you very much. That's me done for this presentation. Hopefully that's given a clear summary of how the volumes of fixed income have favoured this year at Eurex, with a highlight of the BTP and BTS contracts in particular. I will now pass back to Francesca, who I believe has some poll questions to share before moving on to our much anticipated panel session today. Thank you very much.
Thank you very much, Catherine.
Thank you.
So, as Catherine has mentioned, it's now time for everyone attending to actively take part to our conversation by answering 3 poll questions that will appear now on the screen. So, Catherine has hinted towards our roadmap, and we would like to hear your opinion. So, first of all, what type of investor are you? We'll now see the results. So the majority of the participants today comes from the banking industry, but we have quite a lot of people also from the asset managers and broker industry as well. So very good mix of audience. Now we're moving to the second question of our poll. Do you think that it will be useful to introduce ultra-long BTP futures on the 30-year segment? Results from the poll, 58% would see this as a useful product, and then equally no or either don't know. And now the third question. Do you see demand for futures on next generation EU bonds? And here again, the majority would see derivatives product useful in the space. And again, the rest almost equally split between no and don't know. So thank you to everyone for contributing. We will also comment then together with our panelists the results of this poll. So I welcome again our speakers. Andrea from Banca Akros, Ashley from Mako Global, Michelangelo from Horizon Capital, and Jutta from Eurex. So together with them, we will have our panel discussion on the topic dealing with volatility. What should investors keep on the radar, challenges, tools, and future scenarios? So this year, we've seen very severe market movements, and this was a reaction to the fear that's generated by the pandemic. In this context of uncertainty and lockdowns, the Federation of European Stock Exchanges has announced on March 17th that the key aim was to keep exchanges open in order to allow for continuous price information and transparency. At Eurex, we have established a market continuity task force to support all client and market-related questions during this difficult time. We've also seen a very significant increase in our trading volumes in March. So even 5 days in March 2020 have entered into our all-time top 10 daily trading volumes, with an average daily volume of 14 million contracts a day compared to an average of 7 million contracts in 2019. So this has also led to an increased number of intraday margin calls, and we could process them all very smoothly thanks to our last generation risk management system that could auto-adapt its parameters to the new levels of volatility without any manual intervention. And this was key in order to ensure predictability of the margins that were going to be collected. So now we'll discuss with our panelists today the experience they had on their desk, and maybe also with the extra challenge of the home office tab. Italy was the first European country to enter into a full lockdown. So we'll hear the perspective from the market makers and also from the asset manager. So I would start with Ashley from Mako. How was it like during those days?
So good morning. Obviously, it's been a very challenging year with some incredible volatility back in March and April. But from my experience, looking at the core markets from bubble chats, liquidity remained intact. Of course, with the jump in volatility, we had wider bid-offer spreads in the option prices, and market depth deteriorated in the futures market. But the market in the core was functional and tradable. Looking at BTPs, it was a more challenging situation. The volatility in BTPs was incredible back in March and April. So although we retained some liquidity in futures, it was very, very thin, but at least the future held up for hedging purposes. Market makers in the option side were struggling with difficult positions, so we lost two-way pricing in options for a few days. Took a while for the volatility to subside before we got the option market back in BTP. With regard to home working, here at Mako, we were already moving some traders back even last year back to a smart working arrangement. So we had a template for what traders needed to be functional at home. So that template was replicated by the IT team, and it was shipped out by taxis out to people's houses. We were very, very fortunate that we had this big logistic exercise going on, getting people functional at home very, very quickly. So on that regard, I think we did very well.
Good, thank you, Ashley. And Andrea, what can you tell us?
Yeah, Italy actually was the first to go into lockdown, and so we have to a bit quickly adapt to home work with smaller screens, children around. So it was a bit challenging, but in any way, on the markets, there were good liquidity in Eurex products, although the challenging, as Ashley said, was very challenging and volatile. I think that the spike in Eurex trading volume was also due to the fact that the OTC market simply disappeared for a couple of days and was very, very thin. So the BTP market, the BTP future market was very thin, but still was available, and probably got all the liquidity that was on market. On option trading was more difficult, of course, because we had very, very high volatility. like also 20-30%, like equity volatility measures. But we had to show bid offer markets. We did it, but probably few clients really wanting to cross the larger bid offer spreads.
Thank you. And Michelangelo, from the buy side perspective.
Well, all in all, I have to say that the market behaved very well and even better compared to the previous crisis. I mean, all the market players arrived at this crisis well equipped, and so all in all, we didn't see all the troubles we had over the previous crisis. At Horizon, we were already in smart working. As Andrea said, we in Italy have been the first country to go in lockdown, and so we had challenging times, but at the end we got it. As have been said by my colleagues, all the cash trading activity shifted to voice and almost nothing through electronic platforms. And the lower the lower the ratings, and the more the trading was voice. In all these situations, BTP's derivatives played an important role and was an important point of reference in order to price all the BTP's curve. And they showed a very good liquidity and was an important instrument for us in order to price all our trading.
Thank you, Michelangelo. And Jutta, she's our fixed income expert, and she's also worked for many years into our market supervision department. So therefore, she has been assigned to the Eurex special task force for market continuity that I've mentioned before. So Jutta, can you tell us a bit more about the safeguards and the other measures that we've put in place?
Sure. Thank you, Francesca, and thanks for the colleagues for summarizing the experience with the BTP futures. I can confirm we heard the same from other market participants. Regarding the market continuity task force, with the increasing impact of COVID-19 on the international financial markets, the increasing volatility and the uncertainty in March, Eurex immediately established this market continuity task force with the goal to ensure fair and orderly markets, but also to collect questions from different market interfaces, align them, and provide consolidated feedback, answers, and solutions with an utmost level of transparency to the market and to clients in times of high uncertainty. What is important to mention is that Eurex at no point of time had plans to close the market. It was quite the opposite. We worked hard to keep the Eurex market open even under all circumstances and heavy system load. Keeping the market open in general is, in those situations, has a very high priority for Eurex, which we also proved and processed on September 11th, for example, 2001. In general, it's important to say that Eurex trading system can handle a much higher load than which was processed even on the busiest trading days. And Francesca mentioned we were talking about the top 5 here in March. Even on historical peak days, there are still significant buffers, and we did not experience any trading or clearing related technical issues. During that time, we were in close contact with the national authorities in Europe and established information links on the Eurex webpage. Market relevant information was published via circular if required. So what were the main topics we covered in the market continuity task force? As mentioned, was trading halt or trading and clearing continuity, the handle of short selling bans and the impact on existing equity index derivative products, handling of expirations and final settlement determinations, dividend handling due to the delay of dividend payments with the COVID-19 impact, fulfillment of liquidity provider requirements. Ashley, you were involved here as well. Extension of clearing hours and in general clearing and risk related issues. Additionally to this, the Eurex trading system already has several safeguards implemented. They ensure fair and orderly market also under those high volatile market conditions. So those safeguards are order size limits, quote validations, price reasonability check on different levels. Some of them can even lead to a restriction of an order if the prices are too far away from the current market. We have order matching ranges. We have pre-trade risk limits. During the continuous trading, if markets are too volatile, we do have automatically triggered volatility interrupts. And very important also for the liquidity provider, we have some protections with heartbeats, etc., to ensure that they are not left in a market exposure while quoting and providing prices to the market. Last but not least, we have, in case there are some trades which someone believes are not fair and orderly, we have the possibility of trade cancellation and what we call mistrade handling, which is very well detailed in the rules and regulations and transparent and equally to everyone in the trading community.
Thank you very much. So now my second question, I will address it to Ashley and Andrea as market makers. So how are the different types of investors dealing with volatility and the current macroeconomic environment? And have BTP derivatives played a significant role? Andrea, would you like to start maybe?
Yeah, I feel that, yes, BTP futures and options have played an important role, especially because BTP derivatives tend to be like a good proxy for all the peripheral markets in Europe, European government bonds. And we saw a little bit more of non-Italian clients versus the domestic in the BTP future, while the OTC tends to be only Italian clients. From my experience.
Thank you. Ashley?
Yeah, so from Mako's side, say in the core markets, we see a wide variety of market participants. There might be pure volatility players or portfolio hedgers, real money investors. In BTPs, we're seeing more predominantly portfolio hedging activity. So it's more just puts and put spread buying activity, and maybe some real money investors yield enhancing by just selling calls, out of the money calls to enhance yield. So the flows tend to be a bit more one-sided than what we're seeing in the more mature bubble Schatz markets.
Thanks. And Michelangelo, what is then the buy-side view? Can you maybe comment on the different ways of trading through all these different market phases, the order book versus block trading or electronic compared to voice and so on?
Well, just important starting point for me is that BTP is the only liquid futures among with non-high rating underlying. So it's an important tool to implement very quick asset allocation views. Our first choice is obviously to trade on the screen, and because we manage assets for something close to 800 accounts. So screens are our first choice. We usually use block trading during rolls contract period because we get the size to implement this protocol. But all in all, there are a lot of alternatives to trade BTP futures, and both work very well.
Very good. Thanks a lot. So, Jutta, do you have any comments?
No, I think it has already been mentioned pretty much. I mean, from what we can say, we see in general that the BTP futures are, or that the fixed income futures in general are very much order book traded. So in the central limit order book, the majority of trades take place. It is on average 10 to 15% of all transactions taking place in the via block trading, or via, in general, to say, the trade entry service functionality. And if we look at these 10 to 15%, it's rather split between the calendar roles, where we see more block trading activity in the futures, while for the interims period, the activity is rather related to exchange for physicals. So on exchange for exchange of futures against underlying cash transactions.
Okay,
one thing maybe, yeah, okay, sorry.
Thank you, Jutta. Or if you want to add anything, then
Okay.
all good. So I will direct then my next question to Andrea from Acros, because I know that you're also active on the OTC market for BTP options. So can you make a comparison of the trading activity you see on the OTC market versus the listed one? And what was the trend this year? And if you still expect both markets to continue growing?
I think that this year the trend was quite clear. So OTC options are being traded by those accounts that have to have, for mainly regulatory reasons, the perfect match between the portfolio and the option that they are buying or selling. Especially in like or either a protection mode or yield enhancing mode, while the future options are traded more like less as a volatility play and more of a direction trade. So like buying a call spread if you want to play the rebound of BTP, buying put spreads, so less of a volatility trade like buying a straddle or strangle, and more like directional trades. So the clients tend to be keen to express a view on the market, on the underlying market, via options, maybe because they are cheaper ways to play the market, putting very little bit at risk.
Thank you, Andrea. So we are approaching 12 o'clock. I would invite the audience to stay with us maybe for 5 minutes longer, so that we can conclude our panel discussion with the last questions. So I wanted to hear now from Michelangelo from Eurex. Are you also active in OTC markets? And we've seen a Buxel option as a new product. So do you think that listed derivatives for fine-tuning, hedging, and exposure are a useful tool for you?
Yes, absolutely. This is a very useful tool. It's the first quick choice to trade in listed derivatives for the reasons I said before. So I also hope that we will have the next point of the BTP's curve as futures, I mean the 30 years. And yes, absolutely. It's listing derivatives as absolutely the most important tools that we use to implement our bets, our asset allocation view.
Thank you. And Ashley, from a pure market making perspective, how balanced is the flow that you see, and how do you deal with it?
Well, in regard to more developing markets like BTPs and also Buxels, when we're seeing a lot of one-sided flows, what would be easier for market maker digest would be if the clients understood spread trades are much easier for market makers to manage. Outright volatility trades are often very difficult to hedge, where spread trades from a volatility perspective are much easier. Also from the client side, if they're looking for a payoff, so they're looking for a put or a put spread, often the payoff for the client can be just as attractive because they're paying a lot less bid off the spread in a spread trade rather than an outright trade. So just for clients to take that into account, often a spread trade can have a better risk reward payoff than an outright trade, and it's also more comfortable for the market making community to digest those sort of one-sided flows.
Thank you. So I think we will go now into our very last question. I will ask you to keep your answer very short, and we unfortunately don't have time to answer the question coming from the audience, but I will maybe pick the one that is going also into the direction of many that we are receiving, and that it's with respect to the next generation EU bonds. So do you see an impact of this new issuance on the European capital market and on the Italian, or more in general, the periphery market? And maybe I would leave Jutta as last then to comment what our plans are in this direction. Andrea?
Thank you.
Yeah, I see the need for a market that will grow for sure in the coming years. So it will be more and more important. So I expect it to grow and to at least become very important in the mix available to clients.
Thank you. Michelangelo?
I think so. It's an important new tool available to all the investors, and I think yes, if the issuance trends will be the ones we have seen these years, I think we will need a future on these new tools too.
And Ashley?
Yeah, from our side, we're more of an option house, so we have to wait for the liquidity maybe to emerge in the futures contract, and then hopefully going forward we may see some options on these new products. But we'd be glad to see it.
Good. So now we'll conclude with Jutta.
Thank you. So yes, clearly from our side, we are very closely monitoring the development since March and started with some bilateral conversations with market participants, mainly primary dealers, since July after the NGEU program was decided to discuss what is the need for futures, what would be the timing and conditions. Timing is a very important question, as the details for the NGEU bonds itself for the big 750 billion block is not yet really public. However, we have seen the first sure tranches being placed in the market very successfully. That's 17 million, had a sign up for 233 billion in October. So once the parameters are more specified by the European Commission, and we are also in close contact with the European Commission, then we will define a potential futures product in detail, and we will align closely with the market what would be the good timing for a launch. Currently, it needs to be considered whether it's rather treated as supranational bonds or with a certain govy touch, and where it would be placed on the trading desks with the banks. The OAT and the Bund future is currently seen as a good proxy, mainly the OAT future. However, going forward with an increased issuing volume on the NGEUs, we also think that a futures contract will be necessary and well accepted by the market. And we already have market participants who would be very interested in supporting that futures product, and hopefully also as a next step then on the options.
Thank you. So I thank you once again, all our speakers and all of you attending today. You will soon receive an email with the slides and also the link for the replay. So we have received quite a few questions that we could not answer due to time constraints, but we will make sure to address them. And you have our contact, so feel free to get in touch with us for a conversation. So all of you, again, thank you. Take care, stay safe, and we hope to see many of you in person again soon. Bye.